A 63-year-old man sits at his kitchen table, checking his retirement app with a $420,000 portfolio and a $3,600 monthly pension already approved. The numbers look stable, but his finger still pauses over the conservative fund allocation. On paper, he has a stronger income base than many retirees. In his mind, the portfolio still feels like the last wall between comfort and disaster. That is where retirement with a pension starts to look different. The hidden trap is not the pension itself. The trap is that the pension changes the job of the portfolio, while the plan often keeps treating the portfolio as if it must carry every risk alone. The result is a strange contradiction. A retiree may have more guaranteed income, yet still build a plan designed for someone with none. And that difference changes everything that comes next. The system works like this. In a retirement plan without a pension, the portfolio often carries the entire weight of the household. It must create income. It must absorb bad markets. It must support regular spending. It must stay liquid enough for emergencies. It must keep growing enough to fight inflation. One account is asked to act like a paycheck, a shock absorber, a reservoir, and a growth engine at the same time. That is why ordinary retirement planning often places so much attention on reducing volatility. The portfolio is not only an investment, it is the source of monthly life. When the market falls, bills do not pause. Insurance premiums still arrive. Groceries still cost money. Property taxes still come due. For a retiree with no guaranteed income, the investment account may need to send money out even when market prices are unfavorable. In that structure, conservative assets have a clear role. Cash and bonds can create a buffer between daily spending and market movement. They are not there because they are exciting. They are there because the portfolio is under withdrawal pressure. The system is similar to a water tank with a pipe at the bottom. Every month, water drains out. The tank may refill when markets rise. But during a drought, the pipe keeps draining anyway. The danger is not only that the water level falls. The danger is that the tank releases water while it is already low. That is the pressure behind many retirement rules. They assume the portfolio is the main tank. A pension changes that picture. A pension creates a separate pipe, bringing water into the household every month. It may not cover everything. It may not adjust perfectly for every future cost. It may not remove uncertainty. But it changes the first layer of pressure. Before the portfolio is touched, some income has already arrived. That income can cover part of rent, groceries, utilities, insurance, or daily expenses. The portfolio is still important. But it is no longer always the first line of defense. This is where the meaning of risk begins to shift. In a plan without a pension, market volatility can quickly become spending volatility. A falling account balance may force delayed expenses or uncomfortable trade-offs. In a plan with a pension, the market may still fall, but the pension check does not fall with it. The household may still receive baseline income while the portfolio moves. That difference does not make risk disappear. It changes where the risk sits. The pension acts like a floor. A floor is not a roof. It does not create unlimited comfort. It does not answer every tax question. It does not pay for every future health cost. But it does create income that is not directly tied to the stock market. Once that floor exists, the portfolio's job becomes more specific. Some may fill the gap between guaranteed income and spending. Some may exist for irregular costs. Some may serve long-term growth. Some may provide flexibility later in retirement. The problem begins when all of it is treated as survival capital. Survival capital must be protected because the household depends on it immediately. Flexible capital has a different purpose. It can tolerate more movement because it is not being pulled out on the same schedule. The pension is what separates those two categories. But many planning models do not make that separation clearly. They begin with age. They begin with account size. They begin with a risk questionnaire. Then they assign an allocation that looks reasonable for an average retiree. The pension may appear as income somewhere in the calculation, but its deeper effect is often missed. It has changed the job description of the portfolio. The blueprint has changed, but the old labels remain. This creates a quiet redundancy. The pension provides steady income. Then the portfolio is also arranged mainly to provide steady income. The pension reduces the need to sell during downturns. Then the portfolio is still designed as if selling during every downturn is unavoidable. The retiree sees a conservative plan and feels protected. The statement looks calm. The balance moves less. But the calmness may come from using too much of the portfolio to repeat a job already being performed somewhere else. The cost is not visible as a fee. It does not appear as a red warning. It appears only as slower growth on dollars that may have had more flexibility than the plan recognized. This is why retirement with a pension can feel safer and still be misread. The emotional system keeps asking for more protection. The financial system may already have some protection built in. Those two systems do not always update at the same speed. The pension does its work quietly. The portfolio receives attention because it changes on a screen. That visibility can distort the picture. The moving number feels like the risk. The quiet income feels ordinary. But in the architecture of retirement, the quiet income may be the part that changes everything. The mechanism is simple. A pension does not only add money. It changes what the rest of the money is for. Now place two retirees side by side. Both are 64. Both have $500,000 in retirement savings. Both expect to spend about $60,000 a year. Both feel discomfort when the market drops. From the outside, their pictures look nearly identical. Same age, same account size, same spending, same fear of seeing the balance fall. But the structure underneath is not identical. The first retiree has no pension. The portfolio is the main source of retirement cash flow until Social Security begins. Every withdrawal comes from the same pool that is also trying to recover from market movement. When stocks fall, the account still has to help pay ordinary expenses. The portfolio is not just wealth on a screen. It is rent, groceries, insurance, and utilities waiting to be paid. In that setup, conservative assets carry a practical function. They create a waiting room between daily life and the stock market. Cash and bonds are not simply symbols of caution. They reduce the need to sell growth assets during the wrong part of a cycle. The portfolio must send money out regularly, so part of it stays closer to the door. Now look at the second retiree. The second retiree also has a $500,000 portfolio, but there is a pension paying $3,500 a month. That is $42,000 a year before the investment account enters the picture. Annual spending is still $60,000. The uncovered amount is $18,000 before Social Security or other income. The portfolio is not being asked to create the whole retirement paycheck. It is being asked to support the space between guaranteed income and total spending. Same $500,000. Different assignment. This is where theory separates from reality. The theory says a 64-year-old retiree may need a more conservative portfolio because time is shorter and mistakes are harder to repair. That may be reasonable when the portfolio is carrying the full household. But the reality changes when a pension is already carrying part of the household. The account balance may be the same, but the withdrawal pressure is not the same. The first retiree experiences a market decline as both a wealth decline and an income threat. The second retiree may experience the same market decline as a wealth decline, but not always as the same immediate income threat. The pension payment still arrives. The spending gap may still exist, but the gap is smaller than the full expense load. That smaller gap changes the role of the portfolio. Now compare their conservative allocations. Suppose both hold half of their portfolio in defensive assets. For the first retiree, that defensive half may support survival spending. It may be the bridge through a weak market. It may reduce forced selling. It may create emotional stability because it also creates cash flow stability. For the second retiree, the same defensive half has a different meaning. Some of it may still serve a purpose, but some of it may be repeating the pension's job. The pension already supplies a stable monthly base. The portfolio is also arranged to supply stability. The plan may look safer, but part of that safety may be duplicated. That is not a moral failure. It is a role mismatch. The dollars are not labeled by job on a statement. No line says, "This part is protecting spending." No line says, "This part is repeating protection that already exists." So both retirees may look equally prudent on paper. The difference appears when income flow is mapped against expense flow. Before the pension is considered, the two retirees seem similar. After the pension is considered, the second retiree's portfolio carries less immediate pressure. That is the before and after. Before, the portfolio is judged by size. After, it is judged by workload. Before, risk is measured mainly by volatility. After, risk is also measured by whether volatility forces selling. Before, the same allocation looks equally appropriate. After, the same allocation may serve different purposes. This is why retirement with a pension can be hard to understand. The visible number is the portfolio. The hidden structure is the income floor. The visible number moves every day. The income floor appears boring because it repeats. But that repeated income is exactly what changes the equation. A retiree with a smaller portfolio and a strong pension may have less pressure than a retiree with a larger portfolio and no pension. The larger balance is not automatically the stronger structure. The smaller balance is not automatically the weaker one. The real comparison is not account size against account size. It is spending pressure against reliable income. Once that comparison is made, the mechanism becomes clear. A pension does not make the portfolio irrelevant. It changes the amount of work the portfolio must perform. And when the job changes, the meaning of the same portfolio changes. The blind spot is not that pension holders forget the pension exists. Most remember the monthly amount. They know the start date. They may know the survivor option. They may even know whether the payment adjusts over time. The blind spot is more subtle. They know the pension as income, but they may not see it as structure. That difference matters. Income is a number on a statement. Structure is the way risk is arranged. A retiree may think the problem is my portfolio safe enough? But the deeper question is, how much safety has already been created before the portfolio enters the picture? Those are not the same question. The first question places the portfolio at the center of retirement. The second question places the portfolio inside a wider income system. That shift changes the mental model. It moves the conversation away from one large account balance and toward the job of each financial layer. The pension layer handles part of the recurring expense load. The portfolio layer may handle gaps, flexibility, irregular costs, or long-term growth. When those layers are blurred together, every dollar begins to feel like survival money. And when every dollar feels like survival money, every market movement feels like a threat. That is where caution can become difficult to read. It may look like discipline. It may feel like responsibility. But in a pension-based retirement, some caution may be protecting against a danger that has already been partly reduced by guaranteed income. The misconception is that safety always means making the portfolio move less. The deeper reality is that safety can also come from reducing the portfolio's workload. A pension does that quietly. It does not flash on a brokerage screen. It does not create daily price movement. It simply arrives. Because it is quiet, it is easy to underrate. Because the portfolio is visible, it is easy to overfocus on it. That imbalance shapes decisions. The moving number receives the anxiety. The steady income receives less attention. But the steady income may be what changes the entire architecture. Retirement with a pension is not automatically easier. It is differently structured. Risk has not disappeared. It has been rearranged. Some risk remains in inflation. Some remains in health expenses. Some remains in taxes. Some remains in longevity. But the risk of having no baseline income has been reduced. Once that is seen clearly, the question changes. It is no longer only, how much do I have? It becomes, what pressure is each part of the plan carrying? That is the reframing. A pension does not simply increase retirement income. It changes the meaning of the money around it. Retirement looks different with a pension because guaranteed income changes the job of the portfolio, the meaning of risk, and the way financial security is measured. No advice, just observation. The mistake is not usually carelessness. It is often the opposite. Many pension holders are careful inside a framework built for retirees who do not have the same income floor. A person without guaranteed income may need the portfolio to behave like a paycheck. A person with a pension may already have part of that paycheck built into the plan. That single difference can change how bonds look, how withdrawals feel, how market declines are interpreted, and how much pressure the portfolio is actually carrying. The old question is simple. How much money is there? The better question is quieter. How much work does that money still need to do? Because once income is separated from assets, retirement becomes less about one large number and more about the structure beneath it. This mechanism leads to a bigger issue in the next video. Why net worth can make some retirees look secure on paper, while their income reality tells a very different story.